Welcome to Business Buffet, the Help Yourself video series, bringing you fast food for thought. Info you can really sink your teeth into. For best results, first review the program without doing the exercises, and ask yourself the questions in the notebook introduction. Then, zero in on each section, doing the exercises as you go. Here are some of the characters you'll be meeting. You with a business idea. Your competitor with a different idea. Your product or service. Your supplier. Your prospect. And your customer. When you hear this and see this, it's your signal that there's something to do. Have the notebook handy and jot down the ideas you get. After reviewing the whole series, your notes will be a valuable resource. As you plan and grow your business, watching again and again will stimulate fresh insights and creative solutions. And by inviting others to watch with you as a basis for discussion and brainstorming, you can benefit from their ideas too. Now, let's take the fear out of finance. Welcome to How to Read Financial Statements. By the end of this program, you'll be able to define the two key financial statements, describe their major components, and identify the relationship between them. Regardless of why you decided to go out on your own, to a great extent, building a successful business is about managing money. As an owner, you have to manage the financial aspects of your business, balancing costs with potential returns. Financial reports provide information not always visible on the surface. Much like X-rays reveal indications about physical health, financial statements tell you about your fiscal health. And just as a doctor learns to interpret X-rays, you can learn to read and interpret financial statements. The business game is a repeating cycle of selling goods and services, making money, and reinvesting to grow the business. To win, you must have profits at the end of the cycle. To win long-term, you must apply your profits to further your business interests. So, your understanding of financial tools and your ability to use them can make the difference between creating a strategic game plan and playing a game of chance. Your business involves thousands of financial transactions every year. Without the structure of financial statements, how could you possibly manage them? One key financial statement presents a snapshot of your business at a given point in time, balancing what you own and what you owe. This is the balance sheet, and the difference between what you own and what you owe represents your ownership, your equity in the business. The operating statement, the other key report, helps you monitor your performance by tracking revenues and expenses and determining a profit or loss for the period. As the owner, you provide the judgment and vision to maneuver within this structure. If everything you have is financed to the hilt, you have no flexibility. On the other hand, if you have lots of cash, you could put it to work for you and increase your return. Time is money, so let's see how this works. You're in business. You invested some money and borrowed some more to get you going. Then you rented a small facility, bought some inventory, and purchased a van. Lo and behold, you make a sale. Congratulations. Now you're rolling. Or are you? The rent is due, your suppliers want cash, and the bank wants a van payment. Not only that, your customer wants 60-day payment terms, so you'll have to carry receivables. Are you really making money? You still have some cash, the van, and some inventory, and your customer owes you. This is good. These are assets owned by the business. But the business also owes money for the van and the inventory, and owes you too. These are liabilities. Anything left over is owners' or shareholders' equity. On the balance sheet, total assets should equal liabilities plus equity, and they must always balance. Take a moment and list all of your assets and liabilities. The difference will be your equity. Pause while you write, then press play to continue. Now that you know what you own and what you owe, are you making money? Let's look at the operating statement to see where your money's going. You made a sale, generating revenue. Imagine if you could keep it all. But what about the delivery charges and the inventory you bought? These costs are directly related to goods you sold and vary with volume. So subtract them from revenues to get your gross profit or margin. Can you keep the gross profit? Not quite. Remember your rent? And what about your phone? Heat, hydro, parking, gas? And don't you deserve to be paid? These are operating expenses, the day-to-day costs of running your business. After deducting them, you're left with operating profit, money you can use to grow your business. Or can you? Haven't you forgotten something? Well, haven't you? What about your taxes? What's left is net profit, yours to play with. And until it's withdrawn or invested, it's held in the balance sheet as retained earnings. List the costs directly related to the goods or services you sell. Then list your sales and operating expenses. Pause while you write, then press play to continue. Think of your business as a game you must win to survive. It's about knowing where your money's coming from, where it's going, and what you could be doing to keep more of it. The object is to run the business so you increase the value of what you own, your equity on the balance sheet. Should you plan strategically or leave it to chance? Here's how to increase your chance of winning. Each time you make a decision about your business, you impact your finances directly or indirectly. As you gauge the performance of your operations and finances, you can improve the quality of your planning and decision-making. Let's see where you're starting from with an opening balance sheet, so later we can measure your results. You invested your own money, and someday the business may pay you back. So this is considered a loan, and it's listed on the balance sheet as a cash asset and a liability. The bank loan puts more cash into your asset account, but as a loan, it's also a liability. What if your uncle gave you some money as a gift, which you then put into the business? It's a cash asset, but since it's your cash, it's balanced by an increase in equity, your ownership. Notice that although you haven't made a single sale or purchase, your balance sheet shows a good cash position. And when you consider that most of the loans are really liabilities to you, you have a decent level of owner's equity. So the opening balance sheet is your baseline, your scorecard, a summary of what the business has acquired and what it owes, a balance of assets, liabilities, and equity. Now that you're familiar with the tools, let's track where the money's actually going. As a manufacturer, you need some space. To cover rent, money comes from cash on your opening balance sheet. And since it's not replaced by another asset, your equity is therefore reduced. The rent expense will then appear on the operating statement. So you purchase some inventory. Cash comes from the assets and moves into inventory, another asset, until it's sold. Then, bingo, you made a cash sale. So revenues now increase your cash while the inventory is reduced. Of course, the inventory you sold has costs associated with it. The difference between the revenue and the cost of the goods sold is called gross profit or gross margin. Now you need a van for deliveries. Should you use cash or take another loan? Whichever you choose, the van becomes an asset, balanced either by the loan or an equal reduction in cash. Envelopes and other supplies are paid from cash that moves first to office supplies on the balance sheet and later to office expense on the operating statement. Throughout the year, you'll be categorizing every transaction this way, moving money from one account to the other, an action-reaction system. And at the end of the period, there's the profit or loss. And don't forget your taxes. Let's tally the score with another balance sheet so you can see where you are. Any net profit from the operating statement is yours, so it increases your equity with retained earnings. Should you buy equipment? Pay off loans? Take a dividend? Or keep the cash on hand? Until you use it, your money is stored in retained earnings. The inventory you didn't sell last year is carried forward as an asset. And what about the van? It's no longer new, but it still has value and will continue to, hopefully for a few years. Depreciation is a term for adjusting the value of fixed assets as they're used up in the business. You apportion the cost of a long-term asset over its useful life for tax relief, and it's listed as an expense on the operating statement. The operating statement summarizes your operating activities, charting cash as it moves into and out of your business. The balance sheet presents a snapshot of the results of these activities at the end of a period. Check your score regularly, certainly at the end of your fiscal year, and whenever you want to know the net worth of your business. A monthly review is a good rule of thumb. When you understand the relationship between financial statement items, you can get a reading on how well your assets are working for you. It's always a good idea to consult your accountant or financial advisor before making major business decisions, especially now that you can speak their language. This has been part of the Business Buffet Help Yourself video series. Business Buffet, helping small business help itself to profit by making business learning fun. If you enjoyed this overview, you'll want to know about the other exciting products and services specially created to help small business help itself to profit. For information on the growing list of Business Buffet products and services, and to be placed on our mailing list, contact Business Buffet and help yourself to profit. Thank you.